in our fourth module of Chapter 8, our learning objective is to cover the accounting for notes receivable, including the interest computation, and then we're going to move on to our last topic of the module, and that is accounting for dishonored and honored notes receivable. Now, in accounting for notes receivable, again, we said that the three types of receivables that we looked at in this chapter, or at least we outlined, were accounts receivable, notes, and other. And generally, as we said, notes receivable will be characterized by the existence of a promissory note. Promissory note contains provisions that will include the interest rate, the due date, and the amount. Now, the note is signed and interest will be accrued periodically as we need. So to summarize, in accounting for notes receivable, the note on the date it is made is recorded. We will periodically accrue interest and record interest revenue because we're going to have the note receivable, and then we collect principal and interest. And again, you know the document is a promissory note, and it will include various components that you should be aware of. Number one, and we'll see an example of it in a second, but number one, the principal, the amount due. Number two, the interest period. Three, the interest rate. And of course, the note must be signed. So when you look at a sample document from the textbook, the principal amount, the first component is here. It's a $1,000 note. Second component is the date, and that's the period that the interest starts accruing. Of course, the payee is lending to the maker of the note. So Smart Touch is lending to Lauren Holland $1,000. The interest rate is the third component, and of course, the maker of the note, or the debtor, is the fourth component. Of course, Smart Touch is the creditor. So let's take an example. Smart Touch Learning extends credit of $1,000 to Lauren Holland for 6% for 1 year. The journal entry required when we issue the note is going to be a debit to notes receivable, once again specified by the individual that's borrowing the money, Holland. You could, depending on the volume of notes receivable used, you could have a notes receivable subsidiary ledger. Typically, we don't, because the volume of notes used in most businesses, unless, of course, your business is to sell heavy equipment that requires financing, and then you would use the note as a normal course of operations. But typically, we could just use a general ledger account for one or two customers that have specific notes receivable. And then, of course, you debit the note and you credit cash. Now, we did mention that the note is for 1 year at 6%. So the interest is going to be accrued, but in the note, students tend to think that interest is made at this point, but it's not. Interest has to accrue. So the day you borrowed, you don't owe any interest. It is with the passage of time. So we only record interest after the passage of time, and on the date of issuance, there is no interest to be recorded. Now, you should have seen this somewhere in your travels, but interest is based on the amount of time that's passed. And at the end of the accounting period, if the note is not due, but it's unpaid, of course, we have to accrue interest. And it's pretty easy. Probably have seen the principal times rate times time formula before. So that's the amount of interest. The interest rate is always stated on an annual basis. Time is a fraction of a year. It could be a period of measured by days or months. And again, we count, when we do count the time, we count the maturity date, but we omit the start date of the note when we use days to account for the note. Now, in this case, it's a 1 year note, and it's issued on September 30th. And the interest for 1 year is going to be $60. But because the note was only outstanding for 3 months, October, November, December, we take 3/12 of that 60 and we get our interest of 2015. So we only accrue for the 3 months. And again, let me go over to the whiteboard and illustrate this. I know we did this earlier in the course, but this is all part of the accrual basis and the need for adjusting entries. So again, if this is 2014 and 2015, and this is September 30th, which is the date of the note, and then we have the 3 months, October, November, and December. And then in 2015, you have 9 months until September 30th when the note is due. So once again, we said, let me go back to the note itself, $1,000, and it's 6% for 1 year, and we're using months. $60 for the annual period. Then that would be obviously going to be $60 for the annual period, or on a monthly basis. Of course, if we did this on a monthly basis, if you wanted to, you could take the 60, divide it by 12, and you would get $5 per month. It's another way to do this. So at the end of October, you owe 5 in interest. Well, we have earned 5 in interest as Smart Touch. November, another 5, and December, another 5. So we have $15 of interest revenue in 2014. In 2015, we have 9 months times the $5 per month is going to be 45. So 45 is earned in 2015. And that's, again, is interest revenue. And, of course, this is earned as well. Interest revenue. Now, at the end, and in this case, you're not making payments until the end of the period, the maturity value of this note is principal plus interest. Maturity value is 1060. That's the maturity value of the note. So, again, interest is accrued and earned $15 in 2014, $45 in 2016, but you collect everything, 2015 rather, you collect the full amount at that date. So the journal entry to accrue interest on December 31st, which is Smart Touch's year end, we're going to debit interest receivable and credit the interest revenue. Now again, when the note is collected, the maturity value is going to be $1,060. So we know that going into the next accounting period, you have to have another 9 months earned up until the date the note is paid. Now the total interest is 60, but notice the accounts that we use. We do collect the maturity value by debit to cash for $1,060. We credit notes receivable for its face value or the par value of $1,000. Sometimes this is called face value or par value. We credit the interest receivable we collected. This is not revenue. It was revenue in 2014, but not in this year. And then, of course, the interest revenue is the balance. So the maturity value is collected at the end of the term of the note. And finally, in this module, we want to look at recording dishonored notes receivable. Now, an honored notes receivable is when it's paid on time. If the maker or the debtor doesn't pay the note when due, it's dishonored and deemed to be uncollectible. When the note is deemed to be uncollectible and it's dishonored on its due date, obviously the note is a worthless piece of paper. So if the note was due today and it's unpaid, it expired. But what we do is we often take the dishonored note plus any unpaid interest and transfer it to an accounts receivable, where the accounts receivable could be written off when it's determined to be uncollectible. So if, by the way, as I said, if you have a large volume of notes receivable in financing capital purchases by your customers, capital purchases would be very, very large and high dollar assets like generators, jet engines, a fleet of trucks, oil tankers, whatever it may be, airlines. If you're financing that, you could set up a loan loss reserve, which is similar to the bad debt expense. So let's assume that Taylor Company had extended credit for $80,000 to L. King Company on a 90-day 5% note. On the date that the note was issued, there was a debit to the note receivable and a credit to cash. The interest in the 90-day note, now we're using days, the 90-day note is going to be for $80,000 principal times 5% times the fraction of the year that the note was outstanding. And by the way, we're doing this in days, but it's also 3 months, and you get the same result. Okay, it's 25% of a year, quarter of a year. And that interest for the period the note's outstanding is $1,000. Now, when you collect the note, you're going to collect the principal plus interest. So once again, it's P plus I. So you're going to collect $81,000. So you debit cash for $81,000. You credit the note receivable at its par or face value and credit the interest. And don't forget, principal plus interest is the maturity value. Maturity value is P plus I, and that's going to be $80,000 plus the $1,000, or $81,000 in total. And once again, in the event that that note was not paid, let's see what would happen. Let's go to the whiteboard, and if the note was dishonored, let's assume the note was dishonored at the maturity date or at the due date. You didn't collect it, but you would reclassify the note and the interest at its maturity value into notes receivable. So you would have a debit to accounts receivable, credit the notes receivable of 80, and you would have interest revenue of 1,000. And this is a dishonored note, and this of course would be for the same person. So the dishonored note and any interest is reclassified into accounts receivable, which we can now write off if it is deemed to be uncollectible.